What if I told you right now you're probably paying more taxes than you need to simply because you don't fully understand how the tax system works? Hi, I'm Z Friedman and welcome to Tax Tips Canada, the channel where we take the mystery out of taxes and show you how smart planning can help you keep more of what you earn. Today we'll be breaking down the basics, what taxes actually are, who pays them in Canada, and how understanding them can help you build real wealth. Stay tuned because after this video, you will never look at taxes the same way again. Before we dive in, let me tell you a little bit about myself so you know who's guiding you through this journey. My name is Z Friedman. I'm a CPA student currently pursuing my Master's of Accounting, and I'll be writing the Common Final exam next year on track to become a chartered professional accountant. I've been working as an accountant for over 4 years, and I actually began my career in investment banking. Over time, I realized that the true key to wealth is not just about how much you make, it is about how much you keep after tax. That realization changed the direction of my career. I moved fully into accounting and tax strategy, and now through this channel, I want to help you understand taxes so you can use them as a powerful financial tool. So what exactly is Tax Tips Canada all about? This channel is here to explore the real-world choices that taxpayers can make to increase their after-tax cash flow. This means learning how to maximize after-tax income, which also means increasing how much you can spend, save, or invest. Taxes are not just something that happens once a year when you file with the Canada Revenue Agency. They influence behavior, financial decisions, and long-term wealth. Every decision you make, whether it is buying a home, starting a business, or investing, has a tax effect. The goal of this channel is to help you make smarter, more strategic decisions so you can grow wealth legally, efficiently, and confidently. Let's start by seeing how taxes influence human behavior. Now, this is not a new concept as governments have been shaping behavior through taxation for centuries. Here are two examples that show how powerful taxes can be. The first being the window tax in 17th century England. You see, back then, homes were taxed according to the number of windows they had. The more windows, the higher the tax, ranging from 2 shillings for smaller homes to 8 shillings for larger ones. People responded by literally boarding up their windows to pay less tax. This decision left homes dark, poorly ventilated, which caused serious health problems. Eventually, the law was repealed in 1851, more than a century later. The phrase daylight robbery literally came from this period. The second example is the waterfront tax in historical Netherlands. Property taxes were based on how much of a home's front faced a canal. Since waterfront spaces were limited, people adapted by building their homes that were extremely narrow to the front but stretched far back or rose several floors high. These examples show that taxes do not only raise revenues, they shape the way people live, build, and even think, which is why understanding tax behavior is essential for making better financial choices today. Now that you understand how taxes influence behavior, let's talk about how you can take control of your situation. There are two main approaches to tax: compliance and planning. Tax compliance means calculating the correct amount of tax after a transaction is complete or after income has been earned. It involves filling out forms, filing with the CRA, and paying what you owe. Compliance is reactive because it happens after the fact. Tax planning is proactive. It means thinking ahead and deciding how to structure your income or transactions before they happen in order to reduce the amount of taxes that you will owe. Tax planning can take place at many levels. It might involve small business owners deciding how to pay themselves or a family arranging how to share income among members. Remember that the earlier you plan, the greater your flexibility and benefit. When planning your taxes, keep these important things in mind. First, taxes should be viewed over multiple years rather than focusing only on the current one. What you might save today might increase or decrease your taxes in future periods. Second, think about who's paying the tax. Sometimes families or corporations can legally shift income that is taxed at a lower overall rate. Third, remember that taxes come in many forms: income tax, sales tax such as HST, property tax, capital tax, and others. Fourth, taxes affect not just you, but the people in your organization and that you work with. Your suppliers, customers, and business partners all experience consequences of tax decisions. Finally, remember that non-tax factors also matter. Saving money is not worth it if it damages your reputation or violates laws. The best tax planning always balances financial benefit with ethical and practical considerations. Let's clear up one of the most misunderstood areas of taxation: the difference between tax avoidance and tax evasion. Tax avoidance means arranging your affairs within the rules of the Income Tax Act to reduce your taxes, even though your actions might not align with the overall spirit of the law. The General Anti-Avoidance Rule, or GAR, exists to challenge aggressive tax avoidance. If the Canada Revenue Agency finds that your planning was abusive, they can reassess your return and make you pay the taxes you tried to save, plus interest. Tax evasion is very different. It means deliberately breaking the law by not reporting income, creating fake expenses, or hiding assets. This is a criminal offense in Canada and can result in heavy fines or even jail time. Here's a simple example. Imagine Drake reports $6 million of income in a year. He spends $2 million in personal items, begins the year with a net worth of $3 million, and ends it with $9 million. If you added up 3 plus 6 minus 2, his net worth should be $7 million, not 9. The missing $2 million likely represents unreported income. In that case, the CRA would issue what is called the net worth assessment, which would tax them on the extra income they believe was hidden. This is how they detect tax evasion, and it reminds us that documentation and honesty are critical. Now let's talk about what actually gets taxed. The tax base is the item or activity that is subject to taxation, and there are 3 primary types. Income, which includes wages, business profits, or corporate earnings. Consumption, which includes taxes on goods and services such as sales tax, alcohol, or tobacco. And wealth, which covers things like property taxes and estate taxes. In Canada, taxation is shared among different levels of government. The federal government mainly taxes income and sales. Provinces and territories also tax sales and income, while municipalities focus mainly on property taxes. Here on this channel, we'll focus mostly on income taxation because that's where individuals and businesses can benefit the most from effective tax planning. So, who actually pays taxes in Canada? The answer is both residents and non-residents. Canadian residents pay tax on their income from all over the world. Non-residents pay tax only on certain income that comes from Canadian sources. Here's a quick example. Suppose you earn $150,000 in Ontario and $200,000 in Florida in the same year. Suppose Ontario's tax rate is 40%, while Florida's is 30%. By moving to Florida and becoming a non-resident of Canada, you could save around $35,000 in taxes. However, residency for tax purposes is not just about where you make money. You must also consider health insurance, social benefits, and your ties to Canada before making a decision to move. Tax residency can be complex, and this is where professional advice can really make a difference. Tax planning should be part of every financial and investment decision. It's not about avoiding taxes entirely, it's about arranging your affairs in a legal and strategic way that minimizes what you owe. A famous Canadian case, Melville Newman versus the Queen in 1998, confirmed that taxpayers are allowed to structure their affairs solely for the purpose of reducing tax as long as they stay within the law. So good tax planning is not cheating, it is smart financial management. Most tax strategies fall into 3 main categories: distribute, delay, and derate. Distribute, which decides who should pay the tax. This might involve income splitting with a family or between a corporation and its shareholders. Delay, which focuses on when taxes should be paid, as deferring your income can allow your money to grow before it is even taxed. Or derate, which manages what type of income is being taxed. For example, shifting your income from business income to investment income that is taxed at a lower rate. It is also important that you understand your marginal tax rate, which is the rate you pay on your next dollar of income. While your average tax rate shows what you have paid overall, your marginal tax rate is what really matters for planning future income. Keep in mind that tax laws change often. Always verify information with the Canada Revenue Agency or a qualified accountant before making a major financial decision. Next week, we'll build on everything we covered today, including understanding after-tax costs and how they affect real financial decisions, learning about income deferral and income spreading, which are techniques used to reduce total tax, and exploring income splitting and attribution rules, which are also powerful strategies that allow families to lower taxes when used properly. Let's quickly recap what we covered today. We discussed what taxes are, who pays them in Canada, how taxes influence behavior, and why tax planning is such an important part of financial success. If you found this video helpful, make sure you like, subscribe, and turn on notifications so you never miss a future video. If you have questions about your own tax situation or topic you want me to cover, leave a comment below. Trust me, I read every one of them. Thank you for watching, and remember, the more you understand about taxes, the more control you have about your financial future. See you next week on Tax Tips Canada. It's not what you earn, it's what you keep.